Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to Sparta Market Outlook, your weekly snapshot of what's really driving the global oil markets. So it's been another busy week here with geopolitics back in the spotlight, Russian infrastructure under attack and risk premiums creeping back into both flat price and the paper spreads. So I'm your host, Rachel Williams, and joining me today are both James and Neil. Hi both.
Hi.
Brilliant. So look, we've got lots to unpack from distillate cracks and that HOGO trade, Neil, that we talked about last week. We'll see if we called it right on the WTI Brent spread, and let's quickly run through some surprising moves in naphtha and fuel oil too. So look, before any of that, why don't we just get straight into it? So what's behind the sudden return of bullishness, at least on paper?
I will go and I will caveat everything by saying I'm a bit annoyed this week because I felt like we were building up to a really nice short Brent spread trade for weeks and weeks, and it just got ruined, and I feel like an idiot. But
you're good as long as you can caveat kind of why. We're all fine.
Yeah, so to roll back maybe, I think if you take the last couple of weeks, so a couple of things happened. One is that there was a sort of tacit admission from Trump that or let's say there was a change in tone from Trump on Ukraine, and it basically said, Ukraine can win this thing. He had this Truth Social post. He had this speech at the UN, and I think that's also, probably adding fuel to the fire in terms of Ukraine feel that they can go for the jugular. So they are now exploiting this weakness of oil infrastructure in Russia more and more, and it's very difficult for us to make the argument that it will stop. It just feels like it's going to go on and on. So now, half of the refineries have been hit in relatively recent times. And, there's James's talk today, finally, of the Russian diesel export ban. It's not as bad as the headline seems.
Yeah, it's like a partial one, isn't it? Yeah.
Yeah, it's just for resellers, so it actually doesn't matter. But it's still a bullish headline, if you like. And it doesn't sort of prevent a real ban coming into place eventually if these attacks keep on going.
Interesting.
So Brent spreads did touch 90 cents this morning, and flat price obviously up. I was short at 50 cents on Friday and went terribly. So there you go. It's another lesson learned. In hindsight, everything's easy, as me and James were just discussing. But on the other hand, it just wasn't really understanding the risk that was building. You could see all month that Ukrainians were just attacking. I thought part of my thinking was, look, there's loads of Urals on water, there's loads of Urals coming out of Russia because they've been attacking refineries. This goes into my short Brent spread trade. And last night particularly, the news that they were hitting stuff in Novo itself, and Novo is the place where they've been exporting a lot of crude, just adds fuel to the fire on spreads. So even though it kind of made sense to me, it hasn't worked out. And anything's on the cards seemingly just now. So you just can't be short, as we've said many, many times before. Yeah. And it's being expressed in gas oil east-west, in gas oil cracks. It's being expressed in naphtha east-west, which is, naphtha east-west is at the same level as you had immediately post-Ukraine. So it's like plus $30 a ton, plus $35 a ton. It's really, really, really big. And it just feels like oil is perpetually caught between these things, right? Are we in a better supplied crude market than we were a couple of quarters ago? I think yes is the answer.
Yes. Yeah, I'd agree.
But this Russia thing still going on. Is there macroeconomic risk? Yes, but it can't be expressed anywhere yet because demand hasn't gone down that much. And the Russia thing's always in the background. So it's really, really hard. And I had a very tiny taste of apparently what many people have been feeling in the market this year, which is it's difficult to trade.
Yeah. It is. And I think when geopolitics are pulling in one direction and fundamentals are saying something a little bit different, the disconnect is hard to call, right? So
Yeah.
don't get caught on the short side.
Yeah, and it's gone the other way this year, I guess, as well, right? I mean, there's times where you were more convinced about stuff, and then a big tariff headline came along, and that ruins your trade. And it just feels like it's impossible. Is it every second day there's some kind of headline?
Yeah, and look, I think in general terms the market's been feeling it as well. Even in APEC, kind of the sentiment was it's not been an easy year at all. So just on the flip side, so thanks for being so honest on your TI Brent spread position. What other news headlines have we had out in the last week? JODI, I think, came out as well, right?
Yeah, JODI was a good one. I was deciding what to say about it, but I think there's kind of, as we said, for a few months, not really any change on the inventory story. Gas oil demand hasn't collapsed, James. Gasoline and naphtha demand is good. Jet demand is good. In Europe, I'm talking typically, because that's where there's less sort of data. The one interesting thing that I think we should highlight is, I think over the last couple of days, it gathered quite a lot of evidence that everything has gone right in terms of runs globally over the summer. So if you look at Saudi data, that was very interesting. So Saudi runs were up 600,000 barrels per day year on year. They put a lot of crude into those refineries. Massive. And half of that, so 300 kbd went to gas oil exports.
Yeah, indeed.
What was the other bit? I can't remember. Fuel oil was up quite a lot. And the runs have been quite high in various other places. So things went well in Dangote. Indian runs have been high. I think OECD Asia utilization looks like it has gone up a touch, looking at the runs data. Obviously, you can never tell X maintenance, but it looks to me like it has. And another one that came out today was Brazil. So Brazil managed kind of like decade high crude runs in August. So everything seems to be going right over the summer.
So that means that probably in summer we were at max capacity, kind of given where margins were kind of globally, or max utilization, really.
Yeah, I think that's the message. I think everything had to go right. And typically that doesn't last, as you then saw with, for example, Dangote over the last few weeks, right? RFCC's down again. Yeah, I think that, I'm not sure. So on the one hand, I think, okay, we've been giving this message of, there's not enough spare capacity. So when you look at this stuff, you do think, I'm not quite sure, is that the message I should have been saying? But on the other hand, everything has gone right. So that is, and even then margins didn't really sink. So maybe you can make the argument, actually the next couple of quarters, maybe things don't go quite so well. And then we're back to the same message.
Okay. All right. I'm sure we're going to delve into that over the next couple of weeks. Continuously.
Yeah, interesting.
We have tended to talk about kind of have we gone off refining capacity globally? And look, we're always at the mercy of things coming back from maintenance, which I think I picked up last week is going to be sketchy for some. So, and obviously Dangote still got his place in the podcast once a week. But look, as we move forward, Neil, take a breath for a minute. James, it is lovely to have you back. I don't know whether you listened to last week's podcast, but look, we discussed product cracks were looking quite toppy. I think June kind of reiterated that it was buy dips into winter was probably the best place to position ourselves. I'm keen to pick your brains there in terms of how that's playing out. With that said, I'm also keen to pick up on the long HOGO trade that we had some very mild conviction on last week, or Neil did at least. So keen to get your thoughts on that one as well. So how's things on Distillate?
Yeah, as you said, cracks are, well, as Neil was kind of gave some context to, cracks are up over the last week. I guess mostly a sign of those kind of geopolitical premiums to do with Russian refinery attacks. So we've seen the east-west widen out to extreme levels again. I think when you look at the numbers now, it's its widest historical or seasonal level for the last 8 years if you discount 2022, for example. Okay. So that's been enough to point, AG, West Coast India, ARBs, West, from both West Coast India and AG for the first time in a few weeks, actually. That should take a little time, kind of lag, until we kind of see those extra arrivals into Europe, I think. Actually, cracks have been up, but actually ice spreads haven't really been that fussed by the events, really. They've kind of actually continued to trend down.
I make a caveat, so the front spread wasn't fussed, but actually if you look at November, December, we're up to almost 17. So it's up a fair bit over the last 10 days, just to make
thanks very much.
The difference there.
Yeah. And so we've seen the HOGO largely continue to narrow, although after the EIA announcement of diesel and middle distillate bills in the US yesterday, we've seen it find a little bit of a floor.
Yeah, okay, yeah. So the draws yesterday, and we were sort of discussing so there was a draw last week, but we're discussing the builds generally. And I think you had a theory, James, that the RVO has something to do with this. What's your thinking there?
Yeah, well, it's something we're just musing on within the team, but yeah, kind of just continuing decreasing RVO. It kind of, and really that's been the trend since probably mid to end July. It does really incentivize US refiners to place these barrels inland US rather than export. And perhaps it's that's been weighing on heating oil and the HOGO as well. I must admit, personally, I still have a long view on the HOGO from here, actually, as we kind of continue to see US crude runs reduce. So anyway, so kind of thanks for that, Neil. Kind of moving on to like the outlook. Yeah. So probably these attacks on Russian infrastructure, as Neil was kind of talking about, should speed up from here. And as they're kind of homegrown, they don't really need that much foreign support to help. They should continue. And it's kind of really then, with that kind of underlying problem, pretty difficult to be short distillate cracks from here as well, particularly as we approach kind of refinery turnarounds periods globally, and also kind of winter demand kind of speeding up from here as well. What could be
James, you are bullish then, cracks and potentially HOGO going in. So you're doubling down on kind of what Neil said last week. We may have kind of got the timing a little bit wrong in the first few days of this week.
Only a month.
Yeah, that's fine. That's absolutely fine. Yeah. Okay.
Yeah, no, I'm generally bullish diesel, as is my want to be. So yeah, well, I mean, stocks globally for diesel don't look massively healthy. Like US is like a kind of proxy, I think is in line with 2024 and 23 levels, but way below kind of the seasonal averages at the moment. We've got global turnarounds coming up, increasing demand from here. There seems to be some strength in gasoline. Perhaps we'll start to see further yield switches towards gasoline. Maybe that's a bit of a, I don't know, guess. Yeah,
that's perfect. No, just to pick up on that, because I'm quite convinced that one of the reasons I think the HOGO kind of crept up on me, because there was always, in my mind, there always seemed to be a caveat for the US distillate builds, one of which was that they were stealing yield from the other products, right? So the gasoline yields have been extremely low. And the last couple of weeks, you saw that start to turn around. Maybe, just as a very big picture thing, gasoline stocks, for God's sake, are kind of pretty low in the US.
Yes.
And so the yield is turning around again. So I think during the week, I was trying to say, we still wanting to be long the HOGO here. But if you start to see the yield turn around, I start to believe it a bit more, let's say. Things can turn around in the HOGO.
Yeah, and then kind of moving back to the Russian, or the weaker Russian exports, what's kind of some of the effects of that weaker refining? Well, we're going to need stronger refining margins moving forward. And if there's relatively limited spare capacity, then this shouldn't be a boon for crude. I won't get sold by higher margins. And if we think there's limited spare capacity, then cracks could really jump up from here, especially with increasing demand. Thanks very much.
No, that's great. Thanks, James. I think you're right. It's going to be an extremely reactive time going into Q4, especially with headlines and capacity offline. It does kind of question whether people should be looking at refinery margin trades. I have personally been burnt by kind of one of those back in an investment banking day. So if anybody that I know that worked with me in those times, caution there, that's for sure. So, okay. Anything else that we'd like to add on distillates before we move on? Keen to get back to the crude market otherwise.
No, I think that was me.
Good stuff. Okay, Neil, so last week you suggested DFLs might recover. I'd like to explore whether that's played out for the reasons that we discussed. I also want to touch upon WTI. I know we've had a lot of internal conversations about it, and from last week we leaned towards the TI Brent widening. How are we seeing that now?
Yeah, I'll rattle through this quickly. So I think I'm quite surprised by what's happening in the North Sea, let's say. So I think it's one of the places where the physical versus paper disconnect is quite clear just now. And obviously, we just talked about all the geopolitical premiums re-entering the market. And the TFL is super strong now, as are Brent spreads, as we've been discussing. Actually, the FOB premiums in the North Sea have gone the other way. So 40s struggled to get to a premium to dated. Same as the other light sweet crudes in the North Sea. Sverdrup has lost $1 per barrel this week. It's now at a discount to dated. The only thing that I can see is A, the geopolitical premium, and B, this sort of the CIF TI market has been really, really strong for the last couple of weeks, probably because TD25 was extremely strong. Probably the RB cons, from the couple of weeks prior. But as we know, the dated market, the way that CIF market trades, it's basically
it's something that we can't predict very well.
Let's just call it that. Yeah. So But there's a big disconnect between sort of paper and physical in the North Sea in particular. So I do question that, and that was also part of the reason why I was kind of short Brent spreads, because I saw like physical crude doesn't actually look that healthy, and that's still the case. It's just gotten worse this week, and the disconnect is even worse. So I can only really say two things need to reconcile over at some point. I'm not going to say by next week because I'll probably be wrong, but at some stage these two things will reconcile. And just to note also that we have TI Afras now landing quite, even despite all that, we've got TI Afras now landing quite cheap into Northwest Europe once again. So maybe that's a forward signal, let's say. But obviously all bets are kind of off, because if Ukraine starts attacking Russian ports, it's pricing can do whatever it wants basically for a few weeks. Yeah, so TI Brent was the other one. I generally didn't get it too right. I mean, I did make a call a couple of weeks ago that it would widen out, and it was largely a freight story. I'd say the last couple of days it has started to tick wider again, and I did start to question myself about this whole marginal WTI story over the last week. Is there really a problem in WTI? And I started to question it, but then this week's release from the EIA, I sort of convinced myself that it is still a problem, because you got a basically flat progression in stocks. You still had big exports. If it hadn't been for these massive exports, we would have had big builds again. And you have to question, just the wider backdrop. Eventually, these exports are going to be felt somewhere, particularly if there's way more supply around from OPEC, from Russia. You've got Kirkuk volumes coming back into Ceyhan imminently. So it's, for me, I still think there's a push rather than a pull going on for WTI at the moment. And TI Brent's sort of, it's out to minus $4.40 again right now, partly on TD25, partly. So yeah, I stick with the same story. Okay. But I didn't get the trade right.
Okay, no, that's great. We can follow that up next week. Just for everyone listening as well, we are actually recording this on a Thursday. So Thursday, 25th of September, just in case people start picking this up tomorrow. Okay, anything else on crude that we need to cover that we may have missed? Right, let's do a quick whip around then of light ends and fuel oil. Who wants to help me out with this one? Neil, do you want to take it a bash?
Yeah, I'll rattle through it again. So yeah, there's risk appearing everywhere. One of the places is high sulfur fuel oil, right? So cracks are up $2 or $3 per barrel just over the last 7 to 10 days. I guess that doesn't surprise people very much. It's another expression of the Russia risk. But there's a few other things that are happening, right? So one of the interesting ones was looking at US imports of essentially VGO. It's labeled other oils in the weekly data. And that is basically going to correlate with kind of VGO resid imports. And you can see it in the gross inputs versus crude inputs in the US data. So they're starting to input more secondary feed. So there's signs that there's more resid going into the refining pool. And that's also a kind of probably a sign that there is actually more high sulfur material or resid around than there was previously. So those two things do try to balance each other out. But I think there is evidence that there's more resid being refined. We've got a few things in Asia, like the Babco. Yeah, exactly. Babco's starting up its expansion, and it makes, or at least what we think, it makes for actually kind of a more bullish setup for Q4 for high sulfur, amongst other things. So we'll get Huawei to talk about that a bit more as well. On gasoline, the two or three things to mention. The Singapore market came off a lot, Sing spreads, and we don't really know why. There's a few headlines. One is the return of the RFCC at Pengerang, but we think it's maybe a kind of low liquidity story, and spreads were extremely extended, like other parts of the gasoline market as well. But there were also new tenders done for Chinese exports. Chinese exports kind of high, looking at some flows for the last few weeks. And so that's something that is basically remarkable. And the other two things is that the ARA components market has actually begun to strengthen. It's closed off the E5 blend margins. Normally that would be a kind of bullish signal for EBOB, but obviously we're still really overextended in terms of EBOB spreads. So we have to take that with a pinch of salt. And the other thing that's happening in gasoline is rumors, let's say. I don't want to say that it's a report. It's rumors that Dangote, the RFCC, may be returning faster than expected. But you can't really make a trade on that. But that's the rumor, that it will start much earlier than December.
Okay. Oh, interesting. So the yo-yo continues.
Yeah, the yo-yo continues, and yeah, I mean, Phil was making a good point internally this morning. We did a write-up of it as well. Basically, you can't necessarily trust the E5 blend margin as much as you could, let's say, last year, because there has been this spate of outages for a start, for example, Pernis. But also you have moved supply away from the pricing center. So a place like Dangote, if you like, Dos Bocas probably helped as well. So you basically, you can't really trust the E5 blending margin in ARA as the sort of bearish or bullish signal that you might once have done a couple of years ago. So you have to take things with a pinch of salt. So Phil can come on and kind of talk about that next week as well, hopefully.
Yeah, no, sounds good. It would be good to get a bit of a deeper dive into the light ends, that's for sure. But look, if there was kind of one or two things that you guys are looking at going into next week that you would like me to remind you about on our next podcast, what would that be? So looking at your positions, Neil, I appreciate you've covered the light ends as well as crude. So your gift is just one for this week. And James, it'd be good to kind of get your thoughts. I appreciate you're still very bullish across. I
would say very
across the way.
Yeah, I'm happy to go first. I was interested about Neil's point about more resid into the US imports, and if that changes maybe the picture about decreasing diesel yields or not. So I'll be looking to that, I think. And I guess the main two things I'm monitoring are, if we continue to see decreases in diesel stocks in the US because of the long HOGO call, and monitoring again the effect of that on the Russian refinery infrastructure attacks.
Okay. Neil?
I find this very difficult this week.
I'm sure you said the same last week as well.
In fairness, it's bloody impossible, isn't it? I think I will go with I think I'll go with the TI Brent spread, because I'm looking at it now back out to minus 440, which is piquing my interest, let's say. So I'm interested in the TI marginal barrel story again. Can't really say much about Brent spreads or even the sort of the Brent to buy swap, because the sort of things that are happening in the background makes it very difficult.
Okay, well, thank you very much, both. Let's see if we can get Phil back on the podcast next week. And we're going to be firmly into Q4. I appreciate we're trading Q4 already, but we are firmly into Q4 next week with the start of October. So let's see what fun and games that brings us. So that's all for this week's Sparta Market Outlook. So look, we've covered a lot of ground, from Ukraine's refinery strikes, Russian risk premiums, to the push and pull between paper and physical crude, and what it all means for crack spreads and the margins. So as always, it's a market full of cross currents, geopolitics pulling one way, fundamentals another, and freight muddy in the picture in between sometimes. So we're going to be back next week, diving into whether the fresh chaos of the oil market throws at us. And until then, stay hedged, stay nimble, and don't let the cracks catch you out. Thank you very much.
Thanks very much.
Cheers.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.